Welcome, everyone, to today's episode, June 20th. We are releasing these episodes from our company, Cake DeFi, every Tuesday. We're streaming them live on Twitter as a Twitter space, but also recording them, posting them afterwards on YouTube. We are discussing the crypto markets, talking obviously what moves the markets. We discuss updates around our company, thoughts, investment ideas, and just things that are on our mind. And the two of us, sometimes we're three of us, sometimes we rotate a bit, is myself, Julian Hosp, CEO and co-founder of the company, and our head of community, Fabio. Fabio, what's been going on? How is everything going on in the markets right now?
I guess these are the times where true champions are made. I have some flashbacks to 2018, and usually when I start doubting my own decisions, then we are truly in a bear market, and I can see this going on everywhere. Like big Bitcoiners I'm following since like 5 years. There is big capitulation happening. Like one account that is like a super pure Bitcoin maximalist. He's called Bitcoin Tina, and Tina stands for there is no alternative. And he was like the essence of a toxic Bitcoin maximalist, and he kind of capitulated with 50% of his net worth just a week ago, where he like 2 years ago he was super bullish on everything, and now he kind of said, hey, my position was just too big and I can't bear it any longer. And this is what I see happening in every community. Like, doesn't really matter. Like, you have this big discussion going on with proof of work against proof of stake. Lots of toxicity there, where the Bitcoiners are hating against Ethereum, and Ethereum is hating against Bitcoin. So there's definitely a lot of tension, and a lot of people, they don't really see the light at the end of the tunnel anymore. So we're definitely in a bear market, and usually when these things happen, we're kind of close to capitulation. But what bothers me, and this is where I'm also very much interested in your viewpoint, is we have such a high correlation to general market, to the Nasdaq, to the S&P 500, and we're all so dependent on the Fed and the meeting that is happening, I think today, or the announcement is tomorrow. So I guess this is probably the hot topic that that we should discuss.
Yeah, definitely. I think we have a couple of topics. I want to first of all go through a bit of the updates that we have had at the company over the past week. Let's go through those first. Afterwards, obviously, let's uh, kind of review the Ethereum upgrade. We didn't discuss this last week because this all happened afterwards, and also how we at Cake DeFi are going to plan to really add value to the Ethereum network. And then let's keep the juicy stuff for last, talking about the Fed meeting tomorrow. Let's look at the probabilities of the announcements. How many rate hikes? Could this mean for the markets? And yeah, let's kind of go through this a bit. So we are recording all this here, or if you're on Twitter live, on Tuesday, September 20th, 6 p.m. here in Singapore. Markets have recovered a little bit from the massive sell-off over the weekend, especially Sunday, Monday. Absolutely key to understand is that this is not so much the crypto market. It's really a lot more the general markets. We saw the sell-off happening on Monday, then the recovery in the general markets. Doesn't matter if we're talking about the S&P, the Nasdaq, but kind of all over. And we saw a similar kind of behavior here in the crypto markets as well. Ethereum, pretty much the number one sell-off here, 20% down. We're going to cover why this is, what the reasons could be. But as a whole here, markets definitely down over the last 7 days. Recovered a bit over the last 24 hours, but that was not so difficult considering that markets are down 10 to 20%. So a little bit of a recovery here helps. But three things I really want to kind of highlight here on the Cake side. First and foremost, we launched Earn. Today is the official kind of release. We had a week of a bit of a soft launch. Check this out. I announced it last week already. Go to cakedefi.com/earn and really kind of look through the program. It's super, super juicy, super exciting. You can get 11% on your Bitcoins right now, this comes back as native Bitcoin. The way this works is we're matching on the liquidity mining side the pairs with each other. So you only have to submit one side of the pair. You don't have any institutional risk there, so you don't have this institutional lending risk. It's completely transparent. The longer you stay in the product or in the service, the better the security. From a volatility perspective, we call this a volatility protection over time. And so this is something I can really, really, really excite you for in taking a look. I'm not aware that anyone else actually has such a service. I think this is quite nice. We've had a bit of a soft launch over the first week, and now it's really time to get you excited and get you using the own product on our platform. We're going to bring other coins as well. We're starting with Bitcoin right now, and it's going to go into Ethereum and stable coins. And it's going to be definitely a super exciting one. Fabio, anything from your side on Earn? Anything you want to add there, or questions that you've seen in the community that we can add here as well? The blog post here, we're going to link this up. You just go to blog.cakedefi.com. It's going to be in the description down below, and then you can read all the details yourself. But Fabio, anything that you see the community may be asking or wondering?
Yeah, we definitely got a lot of questions. We briefly touched on that last week regarding the volatility protection, and we received feedback. We get that there is room for improvement when it comes to the explanation. It's very difficult for us as well because this is like an industry first product, and sometimes we really need to navigate a little bit to find the correct wording to explain this to everybody. And we gathered your feedback. Like I read almost everything you guys post on Telegram and on Twitter, and there were a lot of questions regarding that. And we are in close contact with. Oh, I didn't unmute myself on Twitter, so I'm gonna go again. So
No, you did unmute, but you clicked on mute at some point. Because you jumped in and out. Right now you're muted, and if you click now, you should go on unmute.
Yeah, so now it should be working again.
Yes.
Okay. So we received a lot of feedback regarding the volatility protection from you guys on Twitter and on Telegram, that there is a little bit of room for improvement when it comes to the explanation of the product. And we want to double down. So we collected all of the feedback, and we're in close contact with the product team, and we try to display and explain this a little bit better so really everybody understands it. But other than that, the feedback was overwhelmingly positive, and we already have a decent chunk of funds in the product. This, of course, today was actually our official launch date. So the socials, the press releases, and everything is actually going out today. So today is for us is the real start, and we will of course monitor how everything moves along the way. Maybe on a side note, not connected with anything you already touched on, but I kind of received the feedback from you guys that my audio quality is not that good. And you might have heard my dog barking in the background. This is because the UPS postman was just knocking on the door with a new mic. So from next week onwards, I have a new microphone.
That's great. Cool. Yeah. So Earn product. Check this out. The other two things we have, if you're in Singapore tomorrow, I'm speaking at Tech in Asia. If you are around already, I know that next week there is Token 2049. A lot of the team is going to be there as well next week. But so if you're here already, speaking tomorrow, drop by. I'll talk about CDeFi and how we are approaching that from Cake's point of view. Also, we've had a massive article on Tech in Asia around our R&D arm, birthday research, how we are investing $50 million here over the next 5 years. A lot of that obviously will go into the DeFi chain ecosystem. A lot of that will go into expanding the R&D side on Cake DeFi. So all of you that are either using us as a customer or blockchains that we have integrated with in the more extended version, you're going to be benefiting from that. And there's going to be a lot of exciting details going to come out of that. So yeah, that's going to be um, that's going to be quite exciting. Yeah, these are kind of the key things I want to announce here. Are there things, Fabio, that I'm missing on what's happened over the last week? I think especially the earn launch, that was the key thing. But is there anything else?
Actually, there is something we teased this a little bit in an email, and I'm just checking the Cake Twitter account because it's right about launch time. We have another promotion that we have scheduled for today. I'm just checking. It's
I
not
didn't
live.
see it yet. No, I didn't see it yet.
It's not live yet, so I might be mistaking. But we do have a promotion planned regarding Ethereum. I don't want to go into the details of the promotion yet. Make sure to check our socials or our announcement chats or the Cake website. It will be very visible on all three of them, and there will be some information following. And the promotion is themed around Ethereum.
Yeah. Speaking of Ethereum, let's hop into a bit of a summary on what happened and yeah, how does this affect like Cake customers going forward? Last week on Thursday, 6:42:42, UTC Ethereum successfully merged. Vitalik celebrated on Twitter. And yeah, that basically it actually doesn't mean that much other than a very technical kind of from a technical standpoint, it was quite complicated. From a user standpoint, you're not going to notice so much right now. That was also a bit of a criticism that Ethereum faced with that they kind of stripped away most of the key things. So it's not that that transaction throughput got changed or anything on the fee structure got changed. None of that got changed. The main thing that was changed was that consensus is now not built based on who does the most work, but who stakes a certain amount of coins, and it's a statistical process on who gets to decide the transactions for the next block. Obviously, with that, there was this major discussion. Fabio had mentioned that around proof of work versus proof of stake, and with that, a group forked off a proof of work chain. The key thing is you couldn't just continue the existing chain for the simple reason because there was a difficulty bomb created that made it impossible to mine. So they had to remove that difficulty bomb. And additionally, they made this foundation address where coins went in. So it was like really hotly debated. That fork at the end crashed massively. It's now less than 1% of proof of stake. I had actually predicted that this is going to be less than 1%. Some people said it's going to go to 2 to 3%. Others said, hey, it's going to be like classic, where like 6 years ago, which really took some significant share initially. But yeah, price really plummeted. Also, the price of, if you actually look at the worst performers over the last 7 days, one of those is actually all these Ethereum mining coins, Ravencoin in this case, and Ethereum Classic, and also the hash rate on the Ethereum proof of work fork completely crashed. And the reason is just that it's just not profitable to mine. And so with that, a lot of the miners actually started selling off the coins. So yeah, they kind of had to counter that, which was one of the reasons, not like the reason, but one of the reasons why actually Ethereum did so badly over the last 7 days. A lot of people were kind of waiting for that pump. They were like, yeah, after the Ethereum merge, a lot of people, like, you can go to Ultrasound Money, quite a popular website now that kind of shows, yeah, the issuance of Ethereum, and they compare it to like Bitcoin and say, okay, now Ethereum is actually even harder money than Bitcoin. I have a problem with that entire concept. And the reason is, I think for Ethereum, it's very difficult to really be considered as money, for the simple reason that Ethereum, I think, has different interests. Their interest is not to be this comes first, hard money comes first. It doesn't matter if Ethereum becomes deflationary or is actually burning more than Bitcoin, or if Bitcoin has a higher inflation. It's more about the entire principle. And I think Ethereum always has innovation a bit in the forefront. It has a stronger utility standpoint in the forefront. But when it comes to this predictability of the issuance, the probability of ever changing what's happening to the kind of issuance, I think Bitcoin will just always be at the forefront there. So while it's nice, and I think it's definitely going to be beneficial to the price, if Ethereum were to go deflationary, I would not start comparing that at all to what Bitcoin could be there. But so yeah, and so then obviously there was a lot of flack from the Bitcoin community or anyone that is like the proof of work. And then sure, really quickly, the SEC kind of jumped in as well and said, hey, staking could actually make Ethereum a security, which obviously got celebrated a lot by the Bitcoiners. And then the Bitcoiners obviously love to point out that the Ethereum staking pools are now relatively centralized. One has to say, though, the Bitcoiners are forgetting a bit that their mining is also not the most decentralized. Sure, it's a bit easier to kind of flip around with the pools, but the centralization or decentralization simply comes from the trust that's happening. At the moment, the reason why the Bitcoin mining is relatively centralized and the staking is relatively centralized is just because people trust it. They don't see much issue with it. And obviously with that always comes a bit of an issue when it actually matters. But we saw this a year ago when, I don't know, 60% of all the hash rate was in China. Then China banned the mining. Bitcoin mining hash rate crashed by 60%, and then recovered, right? So, yeah, both sides of the argument here, they just love to kind of flack against each other. And obviously, Ethereum loves to flack now against Bitcoin and saying, hey, you're so dirty. No one is ever going to invest in you now because you're burning all this electricity. And so there's just this massive back and forth in all of that. Yeah, and so one thing that I want to point out here, and then I would love to hear a bit of Fabio's kind of input on that. There's obviously a huge discussion right now that a lot of staking is happening in the US, and once Cake offers our staking Ethereum staking ourselves, it's going to start end of September, probably more beginning of October. We're doing user testing right now. And once we're good with that, we're going to go live. We are running our own nodes, and our nodes obviously will be hosted in Singapore, which is going to be very, very, very interesting internationally. I don't know if anyone else is actually running their own infrastructure out of Singapore. So what most platforms probably going to be doing is they're just going to white label someone else's infrastructure, which always puts your coins at a certain risk from that regulation. We've had these discussions with Coinbase in the US. We've had this with discussions about getting forked out. So I would just highly recommend that if you're doing Ethereum staking, obviously, if you hold your ETH, it makes sense to stake them because you're just getting pretty much free interest on top. Just keep in mind you're doing this with an infrastructure where you actually know that the infrastructure is run by the platform itself. It's not white labeling something else that then risks something else. And just make sure it's in a jurisdiction that you feel comfortable with. On this case, it's actually relatively important. We've seen now the SEC even stepping in and saying a lot of the Ethereum transactions actually should count for the US because a lot of staking is happening in the US. And we now even see lawsuits around this. And so this is just something you may want to keep in mind. And I think we're going to have a very strong selling point there as a platform out of Singapore, which people always treat as this Switzerland of Asia. And so that's going to be a very, very key point. Once we go live, probably in the next 2 to 3 weeks. Yeah, so I just want to kind of highlight that. Fabio, anything you want to add there from the Bitcoin Ethereum side, or anything else that you feel we need to kind of comment on here?
Yeah, sure. So many of you know, of course, I am a Bitcoiner, and I like my allocations. I mentioned that previously. I'm in the game of hard money. I own a lot of gold and I own a lot of Bitcoin. These are my main positions, and because I truly believe that we need to move into a hard money standard. And Bitcoin and gold are, in my opinion, the two assets then that can deliver up on that. And so I'm trying to be nuanced in my assessment that I'm going to deliver now. But there is, in my opinion, there is 2 or 3 mistakes that are made by the Bitcoiners and also by the ETH community. So the word ultrasound money is super misleading, and it's you cannot compare Bitcoin to Ethereum. It's not like comparing Pepsi and Coca-Cola. They are completely two different things, and the move from the Ethereum side to move to proof of stake is a very reasonable move, because Ethereum plays the institution and VC game. The people that they are trying to cater to are institutions and companies, and ESG is the game in town that everybody's playing. And there are certain advantages and there are certain disadvantages. For Bitcoin, it does not make any sense to move to a proof of stake system. There needs to be work done, and it needs to be super hard to change it. It needs to be super hard to influence. It needs to be as decentralized as possible, and it needs to move slow. On Ethereum side, this is completely the opposite. And so it's two different products. And the bad thing is, and I think you in your interview with Cointelegraph, you made a great point. It's Bitcoin and Ethereum. It's not, again, they're playing two different games and they're reaching two different goals. It's just that sometimes the narrative that the Ethereums present is a little bit misleading, because they also try to say that they are hard money, which in my opinion they are clearly not. Ethereum is not the same hard money as Bitcoin is. Yes, it is used in a digital space to trade NFTs and to have certain coin offerings in a few years ago, but they're completely two different things. And it's actually good that we are having a proof of stake and a proof of work consensus algorithm, because we are still early and we still need to see what works and what doesn't. And like, even for myself as a Bitcoiner, I hold some Ethereum, and I congratulate them for a successful hard fork. The only thing that I think is very misleading are two things: the hard money narrative, which I think they should move away from. They should move into the other directions. And the other thing is the global energy consumption narrative that they drive, that they are saving 0.2% of global energy, because it's just not true. Of course, Ethereum doesn't use the energy anymore, but the energy just migrates to other coins. The miners, they don't sell their rigs; they're just moving on to mine something else. And so now it's Ergo and Raven and
I saw
Ethereum
some
Classic.
report though that there's a little bit of rig selling happening right now because miners are just unprofitable. But like, it's not. It's at the moment it's still like homeopathic doses, not anything major.
100%. But like in the long run, maybe I can make a bridge here. It would be so different if this merge would have happened in a bull run. But right now we are kind of in this toxic phase, in this capitulation phase of the market, where everybody's on super tense, emotional, frustrated. They're down 60-70% on their investments, and it's super hard to see the light at the end of the tunnel. And then, of course, the easiest thing to do is to point with your finger to somebody else and blaming other people, other communities, or doesn't really matter what, for their emotions and their frustrations. And we can see this in the Bitcoin community, in the Ethereum community, and also in the DeFi community. Everybody is playing the blame game, and voicing their frustrations in all different kinds of ways. And in the end, I think it's that DeFi had a very successful hard fork. Ethereum had a very successful hard fork. And things that just seem super bad right now because the price is down. Everybody had these high expectations. When it came to DeFi, everybody was expecting the price going up to, I don't know, about $2 or $4. Ethereum, the same. Arthur Hayes wrote an article and he said that 2 to 5,000 Ethereum is possible. And the expectations were high, and now it didn't happen. But probably in both cases, it would be very, very different if this would have happened in a bull run. In a bear market, there are pumps in a bear market. There have always been pumps, but to have a sustainable pump and to really outperform in the long run, it's almost impossible, because the sell pressure and the macro just doesn't look so good right now.
I think that's a really good point, and I think a fair point. If everything would happen in a bull market, I agree with you there. Yeah, one interesting thing. Again, I think there's no secret. I personally invest very little in Bitcoin at the moment, but that is also I personally invest very little in gold. I've just always been I'm just always someone who struggles with these types of assets, and that doesn't mean that I don't understand why people invest in them. I actually understand it. Just that for me, I've always struggled with these assets, and Bitcoin for me just always been this very safe bet if you believe the crypto market is going up, and I still think that. If I think it's still the safest bet. If you just believe crypto is going up, I think Bitcoin is the safest bet still. I think there's no secret, because I've shared it a lot, that the two largest positions for me are DeFi chain and Ethereum right now. And I just want to maybe, and I don't want to go too much into detail. I shared a bit in a private investor group on Saturday, but last week I had a couple of calls and meetings just right around the merge, and these were very wealthy individuals, and the discussion there was really exclusively around Ethereum. Um, I just want to put some color there. If you are an investor, I really think it should be end. I think it should be very clear that it's Bitcoin and Ethereum. If you just want to kind of bet on the crypto ecosystem, and you should only deviate from that end if you really know what you're doing. But I would just be very very cautious if you underestimate the power that both of those coins have. And obviously, I would hope that if you have Bitcoin and or Ethereum and or DeFi chain, obviously, that you would get cash flow on our platform on those. Yeah. So um, let's transition into the markets a bit on what's been happening. I mean, we have seen this sell off. I posted this on Twitter as well, and it's still not like I want to be clear, right? There was this massive inflow into exchanges. A lot of people are saying, sure, but at the same time, there was like a lot of outflow. This was just repositioning of coins. Doesn't matter. Right afterwards, I think within 36 hours later, we actually saw this massive sell off. And then people started speculating, right? They said, hey, is this because of the Mt. Gox coins? We had discussed this. I also spoke with u-zyn about this. This is not a secret. I always try to preserve people's privacy unless they share this publicly on Twitter. And u-zyn has been very public about that he actually is waiting for Bitcoins from Mt. Gox. So he discussed this on Twitter. And so for those that don't know, u-zyn is the co-founder here at Cake. He has been in crypto since 2010, so a very, very long time. And he obviously has really good insights in if he gets those coins from Mt. Gox. At the moment, he says nothing new, no updates. So it's unlikely that this is actually linked. It is actually more likely that this was more of a false signal, and it was more of a repositioning, and the sell-off actually happened way more because of the general markets. First down massively. Last week, we had one of the worst weeks in stock investing since the COVID crisis. And so, yeah, all of that, and obviously that's not a question, where's all this coming from? All of that is this uncertainty tomorrow, 2 p.m. Eastern Standard Time, which is 8 p.m. in Europe, which is 2 a.m. Thursday here in Singapore. And it's going to be, on the one hand, the announcement on what's going to happen to the Fed interest rate, and what's going to be the signaling going forward for the next meetings. And so I want to spend a little bit of time here on what does this actually mean, and what and maybe some basics. I always feel sometimes people really lack some of the basics, and if you don't understand those basics, then it's really, really difficult to understand these impacts as a larger scheme of things. Maybe really quickly, I think we've never covered that as a really pure kind of basic to understand that. The way, and we're going to simplify that a bit. It's actually a bit more complicated, but to simplify it, in the US dollar world, in the fiat world, money is exclusively created out of debt. So it's purely that you borrow money from someone, and it's kind of a trickle down effect. And at the end, it all starts at the Federal Reserve. It's a really kind of weird kind of concept there. And there's a fantastic book, if you want to read this, called The Creature of Jekyll Island, How the Fed Got Created. Some parts in a book may tend to go a bit into the conspiratorial kind of side, Fabio, totally your kind of stuff. But I would say a lot of in that book is actually quite good. So the Creature of Jekyll Island. And basically, the Fed is a privately held institution that is the ultimate kind of creator of debt in this sense. And it sets a base interest rate. And so any interest rate that kind of follows further down is interest rate that has to be higher than that base rate. And so anything that has more risk, anything that's like more long term, because anything that's more long term has a bit more risk. Anything that adds kind of liabilities that where people could go bankrupt, anything is gonna add on top of that base interest rate. And so this base rate is set by the Fed. And so a couple of base idea that you always need to understand. If the higher this base rate is, the more expensive it becomes to borrow money. So anyone, especially real estate, any kind of business, anything that where you need to borrow money becomes more expensive and becomes less attractive. And we've discussed this a lot. Warren Buffett always calls this as gravity in the entire investment market. So higher the interest these interest rates go, the more the stronger gravity for financial assets is, and the lower the prices will go. And so the key question is, how high can this gravity go? Because at some point, if this gravity goes too high, actually everything just comes crumbling down. And that's where this entire concept of a soft landing versus a hard landing is going to come in. And that's going to be an interesting discussion also to hear tomorrow, to understand that a bit. This is this is the Fed actually still in the belief that they can do actually a soft landing, or is the Fed gonna admit that they're gonna have a hard landing and it's gonna be an actual crash? And at the moment, the communication from the Fed has always been that they're gonna do a soft landing. And so a lot of this just has to do, how quickly are you increasing gravity? Just imagine this yourself, right? Imagine Earth would suddenly have an increasing gravity. All our bones, all our blood vessels, everything is not used to that, right? So if gravity would just go up slightly, we humans would get stronger, and it obviously at some point would also break. But if gravity would just go up by a little bit, it wouldn't really matter so much. But if this gravity just doubles overnight, I mean, suddenly all of us would get crushed, right? And so it's the exact same concept here for financial assets. And we have seen over the last 8 months interest rate hikes that we have barely seen before. We have seen them before in the 70s, 80s, but other than that, we have not seen them before. And so a lot of these questions always, how big are those jumps and what are the expectations there? And so what I have here is a probability of the graph of what people are expecting for tomorrow. That is the 75 basis rate. You can see this simply here. At the moment, the current rate is 2.25% to 2.5%. So if a 75 basis point hike, it would bring the rate to 300 to 325. And the majority of the market, 84% of the market, is actually expecting this to happen. A super, super tiny percentage actually expects a full percentage point. Now, the reason the market sold off so aggressively is because this actually flip-flopped, where before people had expected 0.5%, and now basically no one is expecting 0.5% anymore. The base case, the kind of super bullish case is 0.75%. And now there's actually a significant amount. 16% is not insignificant, right? I mean, it's still tiny, but it's not insignificant. Is actually expecting a full rate hike here. And so the key to understand here is just this uncertainty. Now, I personally believe we're going to see 0.75%, but now it's all going to come down to the signaling for the next meetings, right? So if we assume we end up here at, let's say, between 3 and 3.25%, now what's going to happen in November? And key question here is, this is on the 2nd of November. Remember, midterm elections are going to be on the 8th of November. So it's just the week prior. And so if now here, and this is actually getting quite strict here, people are now actually starting to price in another 0.75% already for November, right? So that is a major, major jump. So we go from 3 to 3.75. That's the majority. 2/3 of the participants actually start pricing this in. For reference, right? And I have this here at the bottom. For reference, this kind of target rate, 3.75, was actually a month ago, pretty much no one even expected that, right? A month ago, the entire market had completely excluded the probability of a 0.75% rate hike. And now the majority actually expects that. And so that entire shift of expectation of increase in gravity, and always remember, right? Investing is a lot about expectation. It's not about the current state, it's about the current state plus expectation. And a very strong conviction about the future is the same in investment as if it were already there. And so that is why prices have been crumbling like crazy. Ray Dalio also came out and said, in this scenario that we are seeing a 4.5% interest rate. So here we are at close to 4%. December, we may see 4.5%, right? That's December. About half of the participants in the market right now is actually pricing in between 4.25 and 4.5. Now, Ray Dalio came out and said, based on his calculations, and Ray Dalio is definitely not a dummy. He's definitely not someone who tries to scare the market. He's definitely someone who's very reasonable. If we see 4.5%, he expects the stock market from current prices to go down by over 20%. That's based on his calculation. So if this were true, and if we actually go to 4.5% by the end of the year, no one knows if we are. You can see here at the bottom, right? A month ago, 0% of the participants had actually expected interest rates to go to 4.25%. There was no one, basically almost no one expected 4% interest rates by the end year. And now a significant portion, actually more than half of the participants here, in total, about 80% of participants actually expect 4% of interest rates or higher by the end of the year. And that could obviously have very detrimental effects. And so that is just where we are in all of that. And so the key thing for tomorrow is not only the interest rate hike. It's not only to see, are we going up by 0.75%? It is about the signaling. It is about, what does the Fed expect? Is the Fed saying, well, inflation is coming down. Yes, it's not coming down as fast, but we see inflation coming down. We're probably going to be a bit softer in November and December already. Then you will see the market is more pricing in here a 50% or 25% rate hike in November. The markets will rally. You will see this. The markets will rally if you see this kind of messaging. If Powell comes out guns blazing and saying, hey, you know what? That's like, we're going to keep loading. Like, this is 0.75. We actually wanted to go for 1% almost, but we're just going for the 0.75. Expect other massive rate hikes in November, December. You're going to see the market really getting crushed in all of that. And so that's going to be a very, very, very difficult week. I mentioned this yesterday in a video where I said I would be surprised if we don't see turbulent swings this week, and turbulent into both directions. We're going to see despair, we're going to see hope, and it's just going to be super uber volatile. And if you try to trade these things, I want to be very honest, it's probably going to pull your skin off because it's so difficult to trade that. I'll leave you with one final statistic, and then I want to have a bit of Fabio's input here. The probability, though, for the stock market to perform relatively well from this day onwards until the end of the year, it's actually not so terrible. If you remove the dot-com bubble here, where we basically traded net zero, the great financial crisis that just wiped everything out, and then we basically have the big recession in the 30s, 1930s, this is a long time ago. All the other times, dot-com later on, obviously Second World War, like post-recovery time, all these times when we actually had these massive negative markets, we did actually have a positive performance until the end of the year. Now, in none of those times did we have such a dramatic possibility of more and more and more gravity, and we actually may see one of the worst performances ever. But there is some light at the end of the tunnel that may not be an oncoming train. Be dangerous, be careful, don't go into a tunnel with light at the end of the tunnel. It may be a train, and especially in this case, we don't know that exactly. So yeah, I'm going to leave you with that right now. Fabio, stuff to add. What do you see? Comments, feedback, community? What do other influencers say? Let's kind of dive in there.
Oh, I love that. The light at the end of the tunnel might be a train. I love that. Yeah, 100%. So I have nothing to add with the explanation that Julian just gave from the September meeting and the November meeting. Like it was a perfect explanation with a lot of that. Let me add my conspiracy twist to it. So the Fed is actually looking quite strong and very committed. Like Jay Paul is channeling his inner Walker. Like he makes a stance. He wants to raise rates. He's committed. He's signaling this. He's walking the walk, not just talking the talk. And the market is really feeling that. If they are going to hike rates, as Julian just mentioned, so 75% and a half percent in November, the market is going to tank. We're still overvalued. 20% is probably even conservative. I would have said we can easily drop 30% from here, and this is S&P 500 and Nasdaq. There is a few questions and variables along the way, and might go slightly into the conspiracy thing, or just wild or dubious speculation. And these are, so the Fed is committed and they are hiking rates. But this has devastating impacts on the rest of the world, and mainly Japan and Europe. Because what happens when the Fed is hiking rates is the dollar is getting stronger and stronger. And Europe and Japan, they can't keep up. And both Europe and Japan, they have two issues. They have higher inflation than in the US. They have lower rates. And they're kind of set into a corner. They cannot move out of that corner. If Europe starts to raise rates, the whole European South comes into problems. So they kind of cannot do it, but they need to. And then there is the demographics that are super bad in Europe and they are super bad in Japan. So just to touch briefly on that, if you hear from this the first time, an economy is made up of three parts. You have consumers, investors, and workers. And right now in Europe and Japan, like the large majority of all three of them, so the most educated working force, the investors with the most money, and also a big chunk of the consumers is going into retirement within the next 10 years. Actually, I think 2019 was the last year before it happened. So gradually, within the next 10 years, this demographic move is happening. And like Germany, for example, is going to be hit the worst they have super bad demographics. And we're still experiencing higher energy prices, which means inflation can easily go into the double digits here in Europe. And I can foresee a scenario where the Fed is actually keeping to hike rates, but they will buy European treasuries and Japanese treasuries. So they're kind of doing quantitative tightening and quantitative easing at the same time, which means the Fed it will hike its rates up and up and up. Europe is kind of the verge of breaking, and Japan as well. And the US is kind of jumping in and will buy their treasuries to this. This is one scenario I could imagine. But if something breaks, in my opinion, it's going to break in Europe, or it's going to break in Japan. Like the US is just in a much stronger position. And there's one thing to add, and sorry if you're from the United States and I'm triggering you with this, but here in Europe, the demographic problem is a lot worse because our population gets older. Sorry, guys, but we have an average life expectancy of 80 plus, while you in the US are in the 70s. So your demographic problem is not that bad because people don't get that old. And here in Europe, we kind of have a much worse problem because people get older. So there's a lot of things that are coming together, which I think it was never the case that the Fed went into a recession. We can talk about if this is a recession or not, and was hiking rates into a recession. So there is like this storm brewing that nobody can tell how it will play out. Like we can all see it on the horizon. It's kind of like the wind is picking up speed. You can feel the rainfall starting, but it's not here yet. What we had a 20% correction, like in the larger scale of things. That's not a real bear market. It's not a real crisis. It's not a depression or anything. But there is something brewing on the horizon. Like the horizon is looking pretty dark.
One tweet that I made, and people don't react to such tweets in a positive manner, but I always feel that they're true, is imagine it's 2020 again, COVID hits, and there's no money printing. Then we would have this crash and we would not have a V-shaped recovery. We would have some companies doing really well, especially tech companies, because everyone would be sitting home, but very likely actually not everyone would be able to sit home because people would actually have to go out and earn money, right? So that these lockdowns wouldn't even be possible. But so we basically had this massive crash. The economy got completely shut down. It got inflated completely artificially. And now the entire kind of central banks in the world are trying to actually bring us back down to what we had at that point, because otherwise we are not that much more productive than we were 2 years ago. And this is a major, major issue, and everyone is feeling this right now. So I would just always love to kind of put this picture in. Imagine COVID hits and there's no stimulus, but there's all these lockdowns. Imagine what happens to the economy. And if we don't find a better way out, and maybe we will, right? I'm not saying there's going to be a hard landing. I'm just saying that the chance for a hard landing is just always strong. Then this is exactly what the economy is going to feel like, and all the assets are going to struggle actually not dipping to those prices that we had at that point, because that's actually what all the central banks want. The central banks even said we want crypto and stocks and all these things to crash, simply because that means that very likely inflation would go down because people just don't have any money anymore to spend. So I just still hope that a lot of these things actually survive from a price standpoint. So I'm not talking like anything is dead. I'm really more talking about that we don't see another 50% in crypto, because obviously that would be massive, massive pain. But if stocks go down 20-25%, I think we have to brace ourselves for crypto prices to go down 40-50%. I just don't see a world where Bitcoin can outperform stocks in a scenario where everything just gets sucked out. And then if Bitcoin goes down 30-40%, I just don't see how the other coins are going to outperform Bitcoin in such a scenario. They're going to underperform. And so, yeah, that's just the painful kind of scenario that I see if we do see that hard landing and not a soft landing.
Maybe to touch on the title that we said, how low can we go, and what does it mean? So a lot of people, they say, okay, there will be a point where the Fed is turning around and pivoting. Just one thing to consider, and I kind of looked back which how these pivots happen, and there is a possibility, for example, that this will be similar to the 60s, where the Fed was actually hiking rates, lowering rates, hiking them again, lowering them again, and then in the end they did a big hike into the 70s. So a pivot doesn't mean, okay, we're going into another 10-year bull market. But right now they're really doubling down on inflation. They're really committed. And how low can we go? So there is this mean 17K max bidding. There is a trader I follow, Capo. He has a huge following, and he makes great calls. And he says 14 to 17K is a good area to buy. For myself, I think everything below 20,000 is a great buy. But how low could we go? I think 12,000 for me would be probably the lower end of prediction. I tend, if I set up buy orders, I'm looking more at the 14 to 70K buy orders, because I also don't want to miss it. But these are great prices, because there will be a moment when the Fed pivots. There will be a moment when this all turns around. It's not that everything is going to zero and it's all over. This is just how it feels, but it's not that this is actually the case. And if you're a long-term investor, if you were thinking for 5 years, 10 years into the future, things like Bitcoin, Ethereum, and DeFi, so on, like coins with strong fundamentals, they are a great buy right now, and they will probably continue to be a great buy, maybe even a better buy over the coming months. So for myself, I stick to the plan. I dollar cost average, I buy every month, and I keep my time horizon for a long way, because I remember very vividly in November 2018, November 2018, when Bitcoin crashed from 6,000 to 3,000. Nobody was standing in line to buy. Ethereum was around $100. Nobody was in line to buy there. And everybody that bought, like 2 years later or 3 years later, people would say, oh, you're lucky that you bought Bitcoin under 20,000. Or you're lucky that you bought Ethereum in the 3 digits. But it's not actually luck. It's that you were keeping your emotions in check, and that you're sticking with a plan, and that you're committed. And this is how true champions are made. It's difficult. It's so difficult in times like this to keep a straight mind. Like, I see the Telegram chats. There is so many people that are completely they're just throwing the towel. They say, okay, I'm selling, I'm out. I think this is not coming back ever. And these are the people that will tell you you were lucky. It's it if it wouldn't be it would if it would be easy, everybody would make a lot of money. But it's super hard. Like, I for myself, I'm a super emotional person. Julian can attest to that. And I struggle in times like these to keep a clear mind. Like the 5 minutes before I fall asleep, I think about, oh my God, I have so much money on the table and I didn't sell, and am I making the right decisions right now? It's very emotional, and probably there is more emotions to come. Yeah.
One thing, because you mentioned this, how low can we go? How high can the Fed basically increase gravity? The Fed basically cares about one thing mainly, because that's a really, really key thing to the entire US dollar economy. And the second thing um, attached to that, which is housing. And so I think if housing were to come down, which there's a very strong chance next year that it does, then I do think the Fed really has to react. I think the Fed couldn't care less about equities, and for sure it doesn't care about meme stocks and crypto and so on. I mean, I probably even think the Fed is like, if we can decimate that by minus 99%, let's try that, right? But one thing that the Fed really cares about are repo markets. And I want to quickly explain to you how they work. And you can actually look this up for yourself. And if you ever see that, so, okay, let's kind of go back to the basics. Back to the basics is, if you see, if the Fed actually lends you money at, let's say, 2.5%, or yeah, 2.5%, which is basically the rate at the moment, then any kind of risk premium on top of that should be reflected in the interest rate. Repo markets are markets, especially lending overnight, so just one night between the largest institutions. So if you then ask yourself, what should be the premium on top of this base interest rate among the largest financial institutions in the US that are generally even backed by treasuries, there shouldn't be much premium on top of it. There shouldn't, because from one night to another, what's the risk that these large institutions go bankrupt from one day to another? It's almost impossible until these institutions don't trust each other anymore. What we then actually see is, we would see that there is a massive spread between the overnight repo rate and the treasury markets. So what a lot of people that understand those markets actually look at is the spread between what these repo rates are and what the Fed has as the actual interest rate. And there shouldn't be much spread in between. If this spread goes up, and for example, in 2018, here, uh, wait, sorry, I need to go 25 years. In 2008, we suddenly saw this spread up also here.com. So that means during these times, we instantly saw that these rates completely went apart in comparison to what the underlying rate was. We saw the same in 2018, 2019. And so whenever this happens, and this was not because like here where the interest rates actually went up. Here, the rate just went up because people didn't trust each other anymore. And with people, I mean these large institutions. If this happens, the entire financial system would fall apart, because this means that everyone starts calling everyone's money. And then we would have a three arrows scenario in the banking industry, because suddenly everyone wants their loan back. And if everyone wants their loan back at the same time, the liquidity isn't there and it would just completely implode. So if you're wondering at what point will the Fed actually lower rates, mainly if they see a spread between the overnight repo market rates and the base interest rate that the Fed sets out. This is the main one. Like, that's the number one thing. That spread should be close to zero, because there is no risk in these large institutions overnight. It's a different story if we're talking about years, right? Is there a risk lending money to Goldman? Is there a risk lending to Merrill Lynch over 10 years? Sure, there is. Is there a risk lending $1 billion to Goldman today and not getting it back tomorrow? Extremely unlikely, right? So there shouldn't be any risk premium in there. If there is, that's when the Fed is going to lower rates. Until then, the Fed's going to sit there and it's just going to raise rates and raise rates and raise rates because they're not going to care about the rest. I know I see all these calculations about the US government being bankrupt and their interest rates going out of being way too high. They cannot cover their payments. This is all bullshit because that's just owing money to itself, right? So the US government can just always raise rates. They always have ways around this. They can always push the can down the road. They can always do this. But what they cannot push down the road, if these banks don't work with each other anymore, because then everything collapses. So that is the key thing to really watch out for. And housing. Why housing? Because if housing goes down, you have civil war. You don't have civil war because the Apple stock goes down or because Bitcoin goes down. But if you cannot live, you don't have roof on top of your family anymore, people are going to go to war. So these are the two things that you really have to watch out for. At the moment, we see none of that. We see housing flickering, not crashing, but flickering. Repo markets are completely unbothered. So at the moment, anyone who says, the Fed cannot raise rates much more, sorry, has absolutely no clue. Just kind of rehearses what they see from someone who kind of makes these really nice models. Um, yeah, any kind of tax payments or something can always be pushed down. It's the government, it's not an individual. So that's just absolutely key that I just wanted to share here. Yeah, I don't know if there's anything from your side, Fabio, to add here.
Maybe just one thing to reiterate, because what does it mean if there is another 30% or 50% correction, and it will be devastating for everybody that, like, during summer, you need to prepare for the winter. And a lot of companies didn't do that. Like here I'm very, very thankful that I'm working for a company that, sorry if I say so, has their shit together. Like we got money for 4 years, we can weather the storm. And it's just, if you look back, there has been times where there is a bear market for 2 years or for 3 years. So I'm very, very thankful, and this is also good news for you as a customer. Cake as a company, we can weather the storm. And in the end, after a storm, there is a new beginning. And if you survive the storm, the waters are empty most of the time. And there is a lot of things you can pick up for free because the storm took care of these things. So yeah, I really hope that the pivot will come soon. And I really hope we don't go into a 2-year or a 3-year bear market. But I, for myself, as a private investor, I'm prepared to do so. I don't need to sell. I have enough fiat on the side, and I can weather the storm if it takes 1 year, 2 years, or 3 years. And I'm really, really thankful that I'm working for a company that is able to do the same.
Definitely. Yeah, I think we're all doing a really good job here. So obviously, if you're not a customer yet, go to cakedefi.com, sign up, get cash flow on your crypto, completely transparent. If you want to work for such an amazing company, we're one of the few companies still hiring, then apply, go to cakedefi.com/jobs, and look for all the roles that we have open. With that, Fabio, thanks so much for the amazing insights. I think a lot of value to everyone. Hear you next week. Fingers crossed for a smooth Fed announcement tomorrow. We're definitely going to discuss this in great detail next week. Stay safe, stay healthy. All the best. Happy baking. Thank you so much. See you next time. Bye-bye.